starting in about 2 minutes. Hi, Wendy.
Hi there, how are you?
I am good, thank you. We're going to kick off in about a minute and a half. $60 seconds. All right, let's begin, everyone. Hello and welcome to the Wall Street Blockchain Alliance's Accounting, Blockchain, and Crypto Assets So You Survived Crypto Tax Season webinar. This special presentation consists of 2 panels. Panel number 1 will deal with tax season and crypto, lessons learned and the road ahead. Panel 2 will address crypto on the balance sheet, what the future holds, and looking forward to an exciting series of conversations with our thought leaders as well. Before we begin, a little bit of housekeeping for today's event. This event is being recorded. This event is provided for general information purposes only. Nothing discussed at this event should be considered accounting guidance or rules proposals, nor should anything discussed be considered legal investment or accounting advice or opinion. All attendees will be in listen-only mode during the panel sessions. We will, of course, reserve time both during the panels and at the end for panel Q&A. Please submit your questions through the Zoom Q&A box as well. And now I will turn it over to Dr. Sean Stein-Smith for his introduction and welcome. Sean is the assistant professor at Lehman College and chair of the Wall Street Blockchain Alliance's Accounting Working Group. Sean, over to you.
All right, Ron, thank you so much for that introduction, and also thank you to all of our excellent panelists and our wonderful folks tuning in today for this critically important conversation, because as we all, I think, are well aware of, the issues around crypto taxation, crypto reporting, both currently and going forward, do have quite a few unanswered questions, open items, and there are some obstacles out there to individuals and firms that are trying to give quality service and advice to our clients. And so we are quite fortunate on our 2 panels to have really expertise and individuals from all aspects of the crypto accounting area, right? From individuals focusing on technology, folks focusing on advisory around taxes, and individuals who are honestly hardcore tax experts. I am quite excited for the conversations, questions, and hopefully a robust conversation on really all of these issues, trying to sort of draw some of these best practices, lessons learned, and hopefully trying to plot out some potential frameworks and some new opportunities going forward. Because as I'm sure it's at least a few of you heard, there was a bit of price volatility that happened earlier during today. And so all of that makes for excellent headlines, a lot of conversations on Twitter and all the rest, but it also creates any number of tax opportunities, tax obligations, and a whole host of other tax-linked issues. So I will try to keep my comments short and to the point, which is always hard, but I am really amped for our excellent panels here talking about issues that are really at the heart of the crypto accounting ecosystem. And so with that, I will toss it back to Ron to introduce our first panel. Ron?
Thank you, Sean. Appreciate it. So let's kick off panel number one, tax season in crypto, lessons learned and the road ahead. Let me turn it over to the moderator for this panel, Mr. Kyle Clark.
Awesome. Thanks so much, Ron. As Ron mentioned, my name is Kyle Clark. I'm a global alliances manager for digital assets at Sovos, and really looking forward to hosting this panel today. Panel one, tax season in crypto, lessons learned and the road ahead. So, in addition to the obvious, we're going to discuss the current landscape of crypto taxation, challenges that currently exist in tax reporting, and really what current guidance looks like and where the gaps are, still to this day. So with that being said, I want to jump right in. And to get started, I would love it if each panelist participating on the call today could introduce themselves, tell a little bit about the organization that they work for, and the work that they're doing specifically in the crypto tax space. And because I can't see the panelists, usually I'd go from left to right or vice versa. I'm going to hand it off to Kel, and then Ryan, James, and Wendy. So Kel, if you don't mind kicking off with an introduction, that'd be fantastic.
Sure, thanks, Kyle, and great to be here today. My name's Kel Canty, and I'm CEO of Verady, where we do crypto tax and accounting. We deal with a variety of organizations, both the professional CPA firms who have clients that are conducting cryptocurrency transactions, as well as we have a light consumer engagement for direct consumers to calculate their tax obligations. And we also work directly with crypto intrinsic using organizations. So we help them with their accounting and their tax directly as well with our platform, which is called Legible. Thank you.
Awesome. Thanks, Kel. And Ryan, hand it over to you.
My name is Ryan Spencer. I'm a tax partner at Friedman LLP in the digital currency practice. I do tax compliance and consulting for a handful of investment partnerships, hedge funds that trade in cryptocurrency, and also advisory for individual clients that are involved in investing in cryptocurrency. I'm glad to be here.
Awesome. Thanks so much, Ryan. James.
Hi, hey Kyle, and everybody. My name is James Perillo. I'm a managing director at KPMG's Alternative Investment Tax Group in New York City. My clients range from hedge funds, private equity funds, and venture capital funds. And over the last 4 years, we've been working, and I've been the national tax lead partner for KPMG's digital asset fund practice.
Awesome. Thanks so much, James. And Wendy.
Yeah, thank you. My name is Wendy Walker. I'm a solution principal at Sovos. I work on our go-to-market team. I lead strategic initiatives. Sovos is the largest private filer of 1099 forms to the IRS. And so we, our clients are many of the exchanges that are reporting 1099s for various transactions. But we also, being a large private filer, we have clients that span a variety of different industries, financial institutions, insurers, gig platform payers, and the like, because there's lots of different 1099 forms. So.
Awesome. Well, thanks so much, Wendy. And let me just say, everyone looks great today. I can't remember the last time I've been on a webinar call with so many people in collared shirts. So it's almost like we're getting ready to go back to the office or something. But well, with that being said, I want to start reflecting on the 2020 tax season, which is pretty much in the rearview mirror at this point. And so I'd like to just ask the panelists to compare and contrast, how 2019 was different from 2020. And I'll start in reverse order this time, and I'll ask Wendy to kick it off.
Yeah. Well, when you think about, 2020 2019 was, everyone was still, kind of issuing the 1099K form for trading transactions. And, then there were many exchanges that weren't issuing 1099s at all. These past few months here, we've seen, I guess over the last 12 months or so, we kind of saw a movement toward more of a concern about the taxpayer from a compliance perspective. And so many exchanges that weren't reporting began reporting. We also saw, people in the industry, tax professionals in the industry come together, even if they are competitors, but the tax professionals come together and sort of maybe align on the way to report some transactions. And I think of staking rewards. When I say that, unlike the trading transactions, many clients just out of the gate sort of began reporting those as ordinary income, and it just seemed to be less of a, I guess, controversial than the 1099B versus K thing for trading. So, but yeah, I would just say generally we're seeing a lot more from our side, a lot more concern for taxpayers and trying to figure out what their tax obligations are, wishing for guidance, of course.
And I would just say, I think that just the landscape, just to set the stage for a second, the landscape it's almost like night and day, right? When I think about both investment funds, as well as just retail investors, the options and the investment options that were available to invest in 2019, you could buy, you can hold, and you can sell. And that was pretty much all you could do. I mean, there were a few, I think, investment funds that were able to maybe do some short transactions over like OTC, but that's all that was available, and even midway through 2020, that's all that was available. And then staking essentially is maybe step one that happens. And so staking becomes like a predominant way where a lot of new tokens that are being issued are issuing rewards and therefore income perhaps to their token holders. And then in the summer of 2020, Uniswap, just kind of blows the doors off of what the crypto landscape looks like. It makes decentralized finance something that all retail investors are able to easily understand with a very user-friendly UI, and there you have it, right? Then there's lending protocols, there's liquidity pools, and DeFi summer of like 2020 really kind of just changes everything from an investment perspective, but also from a reporting perspective, and what tax professionals have to think about and consider and consult their clients on.
Yep. Awesome. And Kel, let me ask you this. You have a little exposure to the B2C side, and during our prep call, we spoke about the IRS operation Hidden Treasure, and of course all the attention that was brought to the digital asset space really in Q4 2020. Kel, I'd be interested to kind of get your perspective from the retail side, and then Ryan, a question I would have for you is, did you see a lot of your clients doing about face come Q4 because of these types of initiatives and this type of attention on the industry?
Yeah, great question, and I'll kick it off, but I'll say that it varies a little bit. The favorite answer for everything in crypto is it depends. So we've actually seen an uptick in a surprising number of clients that had to come in and go, we need to file, or I need to file, or I need my help with my professional and your platform to file the last 7 years. I haven't filed for 7 years, and I've made a lot on crypto, and I was pretending I didn't have to pay taxes on crypto, right? So we've seen a large uptick in that. At the same time, in some of the social channels, and what we're hearing is that they'll never be able to track it, I'm still not paying it. But at the same time, as you rightly mentioned, the initiative from the IRS, bringing together both, the criminal and fraud areas, and we've seen recent action in terms of the subpoenas, that Kraken and other VASPs have to provide. That's virtual asset service provider, another word for exchanges, basically. And that is coming. I think compliance is still at a very low percentage in terms of people, but it's definitely being noticed. It's definitely upticked. And the people who are on the front edge of that compliance and are being encouraged by their tax professional to get on the front edge and get right are actively moving forward to that. But there's still a large proportion that's going to have to be educated, and that's what these subpoenas and hidden treasure and other enforcement actions like that are going to bring to the marketplace.
Awesome.
Yeah, from my perspective, I saw a lot of people that were, as Kel mentioned, not, that hadn't been filing before, hadn't been reporting some of these transactions, looking for guidance for how they should be reporting this and going back and filing old prior year returns. And I think obviously that goes hand in hand with the rising prices. The exposure there was so much more, and I think people on the fence started becoming a little more nervous with what they were potentially up against for not reporting, selling and buying and exchanging their crypto assets. So saw a lot of that, a big influx of people just coming to us looking for that kind of guidance. I think it's going to continue to happen. Who's to know what what these programs from the IRS are gonna ultimately generate. But I think it's people are gonna that aren't reporting, some of them at least are gonna be caught. And I think that fear is out there, and I think people are really want to be compliant at the end of the day.
Yeah. Well, and actually we can stay right on that topic. I think that everyone on this panel would agree that there was more of an effort to be compliant and execute regulatory reporting. Do we think that reporting is accurate? Do we think more reporting is better reporting per se necessarily, or are, because of the ambiguity, are they potentially creating problems potentially down the road for doing things inaccurately? No one's jumping up to take that one. Yeah.
Yeah, how do you know how to accurately, what's the baseline, right?
Yeah.
There's no guidance. And I think one of the things that we tell our clients, like I start every conversation about DeFi or how to tax this with, look, there is like zero guidance here. And so the baseline for whether we're reporting it accurately or not is really falling on, it's the burden of the taxpayer to determine what is accurate reporting, what is supposed to be reported, and how it's supposed to be reported, what the character of the income is, what the source of the what country the income should be sourced to, and we're doing it blindfolded, like in the dark, So it would be great to get some guidance, and I think a lot of our clients, especially my clients specifically, are investment funds, and so they have a fiduciary duty to their investors to report this accurately. They're using independent third-party administrators to help them track and record the transactions accurately. And everyone's just sort of trying to apply the rules that they think apply in the best way they can. And that's a very odd place for accountants and tax professionals to be in right now.
Yeah, I would agree with that. I do think that the reporting is getting better, and I think that the centralized exchanges and venues that are offering products, issuing some form of 1099 is increasing the compliance, increasing the amount of data. But as was mentioned, the rise of more and more people, instead of just doing one or two trades on a Coinbase, getting into decentralized finance, where there is no 1099 at all, and there's very limited or no guidance, in terms of I wrapped a token and then I lent it out, or I did this with it. I did a liquidity pool and I had, impermanent loss. So I get, there's a lot around that as DeFi has grown from 1 billion to 60 billion in about a year, and continues on that trajectory. That as we get better reporting, which is needed from the centralized institutions, that it's almost like a whack-a-mole, that some of it's getting out, and even more complicated treatment with even less guidance is occurring in the decentralized finance space.
I would pivot and say also that, that if you think about John Doe summonses and then think back to Coinbase, and then the trajectory followed was we saw the IRS send enforcement notices to thousands of taxpayers. And then you all just told me how many of them came to you to file their past year returns because they probably got a CPT 1000, right? And so I think, now here we see some more exchanges receiving John Doe summonses, like we're in this same cycle all over again. And the one thing I will say is that I think that some exchanges are reporting that weren't reporting before. And do I think more reporting is going to help? I think the problem is that, like we're saying, without the guidance, increased reporting just means that more taxpayers are reporting following whatever they've interpreted is the best way to do so, right? And so that's not just from an individual taxpayer filing their return, that's from a business that's issuing 1099s too, right? And so that unfortunately in the state we're in right now, even if a business chooses to issue a 1099, many of you know that taxpayer is still probably going to have to interact with the IRS to prove out the details that were reported on that 1099, because again, there's no guidance. And so I suspect, or I have the experience of understanding that some people are receiving 1099s, perhaps with income that shouldn't be, or with transactions included that shouldn't be there. Right. And so I'm just, we're in this cycle of lots and lots of reporting, lots of paper flying around, but I'm not really sure if we're like finding the needle in the haystack is all.
Wendy, a lot of your output is based upon the input from the user, right?
That's right.
The correct cost basis of assets coming into an exchange, or
if they even report it, right?
Included or not,
If they even report it, they'll report like gross amounts, which could, and what do they consider gross? Perhaps it's a transfer off the platform and not really, disposition. So.
Awesome. Well, keeping in the theme of lesson learned and road ahead, focusing on the former here, we've been through tax season in 2019. Now we've pretty much been through in 2020. What did you learn from 2019 going through this process that you, again, tucked away, kept top of mind, expressed to your clients to make sure that 2020 would be easier for them? And what's your big takeaway from 2020? We always say that, tax reporting is a year-round process because you have to start thinking about these things. What are the things, having been through this season, that you're already starting to, ask your clients to be cognizant of and think about as they go into next season? Let me give you an example as people noodle over this. I always say, particularly in the crypto space, people wear a lot of hats. That's always the case. A lot of these organizations would probably still designate themselves as a startup, despite maybe having raised a lot of money and exponentially growing. A lot of times, if the individual that we're working with doesn't have a specific tax background, I always ask them, get started early. If this is your first time, there could be, one, gaps in the data that you need to fill, or two, business decisions on your side that you need to make around, how you're classifying, your operations, which will dictate, how you report. And that's not a, December 29th, call to the CEO. That's probably a call where you're going to want to, loop in James and Ryan and get their opinion. So any type of kind of tidbits like that you're always kind of quick to share with your clients?
Yeah, I'll take it up from there because I think in addition to the compliance that we're seeing and we're advocating that people take more of a year-round approach. For instance, you don't want to be trying to treat, we have clients that have done trades on, December 31st at 11 p.m. Eastern, which I don't know what they're doing with their life, but that's what they're doing. And that's one of the reasons that we actually put in a current portfolio view with realized and unrealized positions on our legible platform, is that I think you're seeing a lot of people, particularly with the rise in the valuation of digital assets, that all of a sudden, they're like, wow, I've got $300,000. Well, you don't have $300,000. You have maybe $200,000 and you've got a $100,000 tax bill sitting in your account that you aren't thinking is a tax bill. You're thinking you're just going to go buy your Lambo with, right? So the ability to do consistent quarterly, at least, what are my realized, unrealized gains, and then be able to do tax planning. And again, we've enabled that tool and we kind of emphasize that because we don't want people to get caught short with this lack of foresight, and then you have a tax bill that you've already spent, right? Which happens to people, that they can, before the end of the year, look at their cryptocurrency gains, which it's hard to say, losses, right? And then be, oh, I'm up, $200,000. I've got some loss in Boeing because I bought Boeing. And then you can do effective end of year tax planning by looking at your tax portfolio beforehand and on a regular basis, and also keep track and not have to deal with the complexities of things like DeFi at the last minute when you've forgotten all those crazy transactions you've done a year before.
Yeah, I mean, I agree, Cal. I think record keeping is so important, and a constant monitoring of your your transactions and what your year to date realized gain or tax bill will be, so you can adjust accordingly, and also obviously mix it in with your, if you happen to have a traditional brokerage account with stocks and bonds, to combine the two, or to look at it as in the total, and plan accordingly. I think the more, kind of going back, Kyle, to comparing the 2019 to 2020, the volume of transactions is becoming exponential. It's it's the speed of technology, and the amount of transactions and the algorithms available, and people that weren't privy to some of these things or didn't know about some of these platforms are now using them, and just the amount of data is astronomical. And I think that goes more to the point of like not waiting till December 29th to try to figure out what you did for the year. And it also puts a lot from the investment fund and partnership side, it puts a lot of pressure on the fund admin companies they really have to, it's a lot more asked of them, recently, with the amount of transactions that are happening and the different types of transactions. And that's been a really big challenge.
Yeah, absolutely. And Ryan, you make a great point on the documentation aspect of it, particularly working in the unknowns. Whatever you pick for your tax methodology, create that paper trail and make sure that, if in the event that you are audited or the IRS, does come calling, you have a very kind of tangible list of actions, and you have that, again, that paper trail ready.
Absolutely. Yeah.
I see, Ron, are you waving to me, or is that a hand up because somebody has a question?
I am waving at you, and someone has emailed us a question. For everyone in the audience, please do submit your questions via the Q&A box. I was hoping to raise this one question by email, and it kind of hits on some of the stuff that we've talked about previously. Kyle, Wendy, Kel, a lot of us around the concept around data quality from VASPs, and the concepts around the challenges of everything from fair market value to, did I get all of the data? Has that, one of the questions that we've received is, has that improved in your experience over the past couple of years? And where are those gaps still?
It has improved for us a bit, I would say. And I mean, Kyle actually could probably answer some of that too, but I mean, I would say from our perspective, clients have had to make some decisions along the way in order to make that a more streamlined process for them. Whether, again, this goes back to when everything's black and white or everything's gray, you have to sort of kind of interpret things, right? And so from our perspective, whether it's, a valuation, the pricing that they're going to rely on for how they value the assets, or what they're going to call trading periods, those types of things. We've even here recently with clients that are looking at flipping over to 1099-B reporting, we've been looking at, are there 1256 contracts in there? How can we aggregate, data, certain parts of data, not certain parts of data? So there's a lot of kind of tax technical going on that,
Awesome. I don't know if anyone has anything to add. And of course, at Google, they say more data is better data. But of course, if that data is junk to begin with, maybe that's not necessarily the case. And, we could have a vast dichotomy of knowledge bases on this call. And I think that when we talk about, data in the traditional market, in a lot of ways, you have a single source of truth. Well, that's not the case in crypto. And, when I think about, Kel, you had mentioned the rise of DeFi, and of course, Ryan and James, I'm sure you're seeing more and more and more, institutional clients get into this space, and talking about fund admins that you had both referenced, and I certainly don't envy their role right now, but as they get more involved in this ecosystem, they start to integrate essentially what are traditional operations in with this new ecosystem of organizations, of products. What's keeping them up at night? Or, I mean, do they sleep well knowing that they ask you these questions and you're just giving them answers? Where does the ambiguity for them exist? And, not to get too off topic, but do you think that ambiguity is a hindrance on, further institutional engagement?
So I'll take this one for a little bit. So I think the admins, number one, I just want it for all those admins out there, if you're out there, just a shout out to all of you. Everyone I've worked with has been really great, and you're doing really great work, and it's very complicated, and it's very difficult. And DeFi was something that happened, and it happened to everybody all at once. And so everybody wanted to invest in it, everybody wanted to participate, and it left. And there was no warning that it was coming, right? So all of a sudden we needed to, I was on the call trying to figure out what it was myself, just personally, right? How to use Uniswap, and trying to think about what that means for me personally. And I have phone calls from clients that are asking, what are the tax implications? Can I do this? What are the rewards? How are the rewards taxed? How is the liquidity pool token taxed? Is it taxed? And so it's education, and then there's the investment team, and then there's the back office, right? There's the reporting, there's the admins. And so everyone is at different levels of experience and knowledge, and it really requires a lot of conversations. And I think one of the things that I'm seeing a lot is, this is a difference between 2019 and 2020 also, is that my clients are reaching out to me proactively. The conversations I have with both my hedge and my venture capital clients are, hey, we are thinking about doing this. Let's get on a phone and talk about it. And then let's explain how we're going to use the protocol, right? How we're going to transact on the platform, and what we're going to do, and then you can come back to us with what you think the right answer is about this, and let's talk about it, because there are options. Like Wendy said, it's gray. And so there's sometimes options on how to report, because there is no guidance. The admins, the admins are one thing that I've seen a lot, and it has a lot to do with valuations increasing and new funds launching, is that a lot of admins take on the KYC AML process for new investors. And so a lot of people have just made a very large amount of money, and they would like to make in-kind contributions. And one of the biggest challenges that we're having is that administrators are having, and that funds are having conversations with their investors about, potential investors, is whether or not they're willing to accept in-kind contributions, and how you can verify that the contribution made from wallet A into the fund's wallet is actually coming from Jim Perillo, and not from some other source. Because currently there's no, there are ways to tell, and there are ways to do it, and our clients are working on ways to verify that, but it's not as easy as just contributing stocks from your 401k or your IRA. The other few things that we're seeing is keeping pace with innovation. So when it was Uniswap and Aave and in Compound, we have admins that are trying to figure out how they work, what the rewards are, how the income is going to be earned, how the transactions should be booked. But what we're seeing with newly launched funds is that there's new strategies, mostly DeFi focused, and they're not just using those 3 or 4, right? They're going to use whatever's out there, whatever's available on whichever chain that they think is going to earn them the most return on their investment. And so all of a sudden, the admins have also become, you need a dedicated tech team that's going to understand how they work, identify what information is relevant, extract that information, and digest that information, and present it to the auditors, to the tax professionals, and to the client in a way that's the way that they would like to see it, so that they can make the decisions that they need to make on a daily, monthly, or annual basis. There's others as well. There's off-chain accruals that are happening, like so Sushi Swap, for example. When you use Onsen, right, which is this program where you participate in low liquidity liquidity pools, you're rewarded with sushi. The thing about it is that the accrual of the sushi tokens is done off chain. And so even though I log in and I can see how much sushi I've been rewarded, when I look at my wallet, the sushi is not there. And so there's a need for the administrators to work with the clients, the funds, and these protocols to develop like best practices on how do you determine what's in someone's account, quote unquote, when it's not in their wallet. And so those are a few. I don't know. I'll kick it over to some other people to hear some other ideas, but those are a few that I know are keeping them up at like night because I'm talking to them about it like on a weekly basis.
Yeah, at night, I'm sure too.
I do know that some of the admins we talk to are looking at how deep down the rabbit hole of DeFi that some of the proposed new funds are going, and simply saying no, we're not going to accept you as a client because you're off already in left field. You're off of left field. You're down the road 13 miles, and we can't necessarily deal with that. We can deal with a couple of things, and things like Sushi and Uni and others that are doing what's known as decentralized swaps, where it's kind of like a trade, but it's on the blockchain instead of a centralized exchange, are where they're comfortable. And even then they have some issues with pricing and execution and things of that nature. But when you start going further down there into various auto compounding, liquidity pools, and you start getting into that area where there's no treatment. The data is kind of hard to get to because a lot of it is embedded in not just a smart contract, but a chain of smart contracts that aren't necessarily coupled together that you can follow without actually doing some really hard work, which we're actually in the middle of finishing out a build out of a structured tax and accounting for DeFi. And we're going one by one because each one's different. That's where I think some of the admins are saying, we can go this far, but we love crypto and we're glad to have you as a client. But at the point at which the administrative costs and the education within our organization becomes so high and so expensive that we can't take you on, we have to be cognizant of that fact, because at some point it's just what's that phrase? The juice isn't worth the squeeze at the standpoint of, somebody makes X amount, but it costs, you can only charge so much from a market standpoint, but the amount of work required to do the job correctly, which is what admins do, is just too much at some point.
Awesome. And, Ryan, a question that I would have, and going off of what James mentioned earlier, and I always say, I bet 70% of the conversations that I have with players in the digital asset space, or maybe in the traditional space, who are thinking about getting involved in crypto, they're not doing any reporting. They're just kind of staying away. They want to learn. How many of those types of conversations are you having with players on the institutional investment side? They're saying, hey, this is what we're thinking about. Where does the compliance risk exist? Are those questions they're asking you, or are they saying, hey, we've decided to do this, let us know what we should be worried about?
Well, for the most part, they're usually, unfortunately, coming to someone like myself after the fact. So they've already delved into whatever they're doing. Whether it be just buying and selling crypto assets, or doing DeFi trading activity. But it's always, for the most part, it's after the fact. From an institutional side, or from our hedge fund clients, they are being on the other side of that fence. They're coming out. They're being more proactive, as James mentioned earlier. They're trying to, because they don't necessarily understand 100% the tax ramifications or rules regarding some of these things. So they're actually coming to us earlier on than they used to be. But more, primarily, from an individual side, it's one of two things. It's either someone who already kind of knows what they're doing and has been involved in it, and now it's kind of a mea culpa, like I need to start reporting my it's getting the volume or the amount of money that I'm dealing with here, I really need to come clean, so to speak. Or it's someone who, is kind of dipping their toe into doing this, and they're coming to us afterwards, like, now what do I do? How do I get this on my tax return?
Yep. Okay. Awesome. Thank you
And
for
so,
that.
with the institutional investors, for example, I know there was just not an announcement, but it kind of came out on Twitter that Aave has sort of opened a, what did they call it? It was like a pool. It was like an institutional pool for institutions to kind of be able to go through the rigors of KYC in order to use the pool, and then also get to kind of understand how DeFi works. Like they said, practice Aave and the lending protocol before diving into DeFi. And what you can probably see over time is that there will be sort of like permissioned pools where there will be KYC regulations on and requirements in order to participate and to transact on some of these pools. Where are we seeing like there's the high risk, there's the low risk, and then there's like somewhere in between, right? The high risk are like doing like I don't know, like lending and borrowing on some of these like very, very new, let's say non-ERC20 protocols, just because people are still trying to wrap their heads around ERC20 protocols, right, and pools. But there's like Gemini, for example, is a custodian that they provide lending, like you can earn interest on your tokens, right? And BlockFi, I know it's in the news right now, but generally speaking, you're allowed to lend your crypto and borrow against it and pay an interest rate. And so there are ways where I think even conservative folks that are very conservative and are worried about the tax implications are willing to kind of go out on a limb and earn a little bit of beta on their tokens that they're not going to sell. And so it's there. It's a little bit less risky for sure. The returns are a little bit lower, but there's something there that you can do. And the question, that's where I think we see some of our more conservative, but like long-term holders of cryptocurrency. That's where they're kind of playing in the space, just trying to earn a little bit of, let's call it interest, even though that's a loaded word, on their holdings.
Right. And James, knowing that we have a lot of different backgrounds on this call, we had a question come in. Can we talk a little bit about what Aave and Uniswap are at a high level? And then Kel, I'm going to turn right over to you and ask, as a solution provider, what makes these things so difficult to build an accounting back office system for? And again, you could probably have a webinar dedicated to this topic alone, but at a high level, where do the glaring challenges really arise?
Well, at the base level, so as I may have mentioned, so Uniswap is the leader in what's known as decentralized exchanges, where you can execute a swap of one, generally Ethereum, token for another token. And at that level, that's pretty much solved in our platform and much more straightforward than some of the other things. So what happens beyond that, or as relating to that, is something called a liquidity pool, where you have just kind of a crowdsourcing of the liquidity available for that trading activity. And that's where it gets to be a little more complicated. So if you're putting in a pair of, say, Ethereum for storage, so you're contributing equal amounts of those tokens into a pool to be used as liquidity to facilitate trading, and then the decentralized exchange, say Uniswap, will take a portion of a fee from that and actually reward someone who's provided liquidity to that pool. Then that gets a little more complicated, because different ones do them in different ways, and they're embedded in smart contracts. And even then further, sometimes there's a reward mechanism where you can get a governance token or another kind of compensation token in return for being a liquidity provider. So there's mechanisms on top of mechanisms, and some of that complexity is embedded in a smart contract, which is computer code that runs on the blockchain. And so in order to do it correctly, you have to look inside of it. And we're doing it for the top 10, as well as we do all DEXs pretty natively right now. But even then, when someone takes and builds a new liquidity pool provider or There's even ones that will manage different liquidity pool providers, and there's a layer on top of that. So you're going through tranches or areas of put in a token into here, we'll manage it, we'll put it in one of these liquidity providers, and then maybe even a group of them. And then you're dealing with, say, 4 or 5 groups that then roll over into another tranche, that then roll into another tranche, that roll into the original funding, that then has a combination of compensation tokens as well as the liquidity provisioning. There's things like impermanent loss that isn't totally obvious to people. And I'm probably beating a dead horse at this point, but it's a little complicated.
And just to give some context, there's like, it gets, if you go right down the, I guess, rabbit hole is what a lot of people say, right? And it gets very confusing very quickly. Just to give some sense to those who aren't familiar with what a liquidity pool is, it's like, there's like $20 million of Ethereum and there's $20 million of storage, and it's just sitting in a pool. And Jim Perillo comes over with $100 of Ethereum and he wants $100 of storage. In the past, I may have had to take my $100 of Ethereum, sell it into USD on a centralized exchange like Coinbase, then take my $97 because Coinbase took $3, take my $97 and buy $94 of storage because they're going to charge me another $3 as I buy. And so now I'm stuck with $94 of storage. And it took 2 transactions to get there. What the liquidity pool does is it essentially creates this opportunity for me to exchange Ethereum directly for storage. And there is a small fee, but it's much smaller, like 0.3%. So I'm gonna put in $100 of Ethereum. I'm gonna get $99.70, or I might be doing the math wrong right there, but $99.70 of storage back. And I've just transacted with a group of, and the people that are in the pool exists with Ryan and Wendy and Kel's assets that they have contributed into the pool. It's the equivalent of trading Tesla for Ford stock, which is something that like was incredibly revolutionary. Not, this isn't tax related, but incredibly revolutionary in a number of ways. One of which is that it added liquidity to a bunch of tokens that existed, but were not being traded on centralized exchanges. So if you owned this token, right, last year, and it wasn't on Coinbase or it wasn't on Gemini or it wasn't on Binance, it was essentially worthless, right? And Uniswap came out and allowed people to take the tokens that they held that were illiquid, put Ethereum into a pool, which is a very liquid token, right? And allowed people to buy and sell those illiquid tokens and provided a massive amount of liquidity to the market. Really transfer, like it's incredible what it's done. And so there's a lot of tax implications, not only from the Jim Perillo who trades my Ethereum for the storage, that we can probably figure out what the tax implications of that are very simply, right? However, with the exception of value, which we'd have to discuss. But for Wendy and Kel and Ryan, who are all contributing into the pool, who did I just transact with? Did I transact with a smart contract? Did I just transact with all 3 of them at the same time? And how are they recording the transaction? It's the weird thing about trading not into and out of USD, but trading one token for another, is that I am simultaneously buying and selling something at the same exact time. And so it's a very weird process. It's very difficult to record. And that's one of the things that administrators are having trouble with. It sounds like it looks like it's one of the things Wendy's having trouble with. And it's one of the things that like we're having trouble like wrapping our heads around, quite honestly, because it's so new and so unlike anything that we've seen in our years of practice.
Yeah, that was a great breakdown, James and Kel. I appreciate that. And, again, for anyone on the call, automated market makers, one of the greatest innovations to come out of DeFi. And, you look at the fiasco with Robinhood and GameStop and Citadel, this will have an impact on how situations like that, manifest or hopefully don't manifest at all and correct themselves. So again, I would encourage everyone, to do a little bit of independent research on that. I want to start shifting from looking in the past to start living in the present and looking to the future a little bit. And, Wendy, something that, we've discussed on calls before has been that, the IRS so typically creates payer specific guidance, which is to say that the IRS mandates, regulations and guidelines for the institution. And then the payee, the retail, the individual investor, comes after that? Well, in crypto, very often we're seeing guidance being issued to the payee, which sometimes might conflict, or maybe that hasn't been necessarily ironed out and settled on the payor side. So can you expand a little bit kind of on this predicament and some of the challenges that it causes?
Yeah, it's frustrating to say the least, right? So just by way of background, so businesses, any business in the United States is obligated to issue and file 1099s and other returns related to transactions that they conduct. And the IRS has over 30 different 1099 forms, or information returns, I should say, for reporting. And there are very nasty penalties that the IRS can levy against a business for either not filing a return when they're required or when they file returns late. And since the business is required to issue the return to the taxpayer also, then those penalties can be doubled. Right now, a single penalty is $280 per return. So, effectively for every error a business makes or every form they fail to file timely, right, they're liable for close to $560 penalty here for each return. So it stands to reason that they want guidance from the IRS, right? The IRS uses a lot of different resources, as you kind of alluded to, Kyle, to educate businesses on their tax obligations. There are, for all of those 30 different information returns or more, there are specific publications for the business filer that describe each and every form, each and every box, exactly who should file, what to file, and when they should file it, and how to file it. When new requirements come, the IRS or Treasury usually starts by providing the industry with like a notice of proposed rulemaking. It will describe the way that they are thinking about implementing the requirement, and they request feedback from the industry. If it's not a new, tax law requirement or a new change, just a clarification that's needed from the IRS, they usually use things like revenue procedures to address specific transactions, that they might have become aware of that need guidance. The IRS hasn't done any of this around crypto, right? So the 2014-21 notice contained a little bit of guidance for crypto investors on how to report and pay their taxes. It also contained a little bit of guidance on some transactions for which maybe a 1099 miscellaneous or W-2 or 1099K might be required. We didn't hear anything again from the IRS until 2019 when we got the revenue ruling, which was specific to individual taxpayers in terms of how they should treat airdrops received from hard forks, right? And we got expanded FAQs then too. And again, we got no 1099 guidance for these businesses. So we have crypto lending, we have staking rewards, we have crypto trading, we have initial coin offerings, we have crypto debit cards, and we have no guidance addressing any of it. So all of this noise from the IRS, Operation Hidden Treasure, and these CP 2000 notices to crypto investors, the John Doe summonses to exchanges, but not a thing has been provided to these crypto businesses who are on the hook for so much liability, not only to the IRS, but also to the crypto client who needs to report their taxes.
Sure, and staying on the payor, the VASP, as Kel mentioned earlier, the virtual asset service provider, who has some type of reporting obligation, we imagine, and it seems that we're seeing at least increased reporting or attempted increased reporting. What's driving that? Is it the fact that these organizations are saying, geez, look at all the institutional movement that's been taking place in the investment. We need to at least start to the best of our ability to use compliance as a competitive advantage? Or is it a situation that's being driven on the retail side where their users are saying, hey, my 8949 references the 1099B, 77 times, but I'm trying to pull in, 1099K data. So is the push from a compliance standpoint, or is it from, making sure that the users, the clients get what they need? And that's really a question for everybody.
Well, from my perspective, it is a little bit of both. I would say, because when I think about, for example, Paxos, who is a registered registered trust company, you know, they have obligations for tax reporting based on some of the work they do. And so, you know, there's a company that they're concerned more about compliance. They are and have been from the get-go. There are others out there, I think, that absolutely something that I'm seeing for those who are, I'd say, less concerned with compliance initially. It's very interesting for me to see them respond so much to their crypto investor client who is receiving all of these CP 2000 notices and needing help and needing guidance. We're seeing tax centers be stood up on many exchange websites to try to give these taxpayers information. So yeah, some of them that we're talking to are talking about ways we can help provide information at times through the year. I think someone was talking earlier about understanding your quarterly, you know, kind of where you sit quarterly as opposed to waiting until the end of the year. So many of the clients who were less concerned about tax for their customers in the past, it does seem to be more of a driving factor. How do I help them? How do I get them the information they need to work with the IRS? Unfortunately, I just think that as much as they want to provide their clients with a positive tax experience, you know, for all of their investments, it's just it's obviously difficult without the guidance.
Sure. I don't know if anyone wants to jump in on that. You know, two things that I will highlight as just kind of outside perspective. You know, one on the CP 2000 notice side, and of course that is a letter that's generated from the IRS if, you know, more or less your debits don't equal credits. They've acknowledged that, you know, you probably screwed something up maybe on their side, so they're letting you know about it. You know, in full transparency, I received a CP 2000 notice this past January from 2018. So, I mean, you're talking about a 3-year lead time. So if there's anyone on this call who thinks they're in the clear, you may want to check that. But then also, you know, if you're in a situation where you're executing reporting for your clients and thinking that you're doing it the right way, you know, hold on to those records, you know, longer than you're supposed to, of course, but you may have, you know, clients, users reach out, you know, further down the road and ask for data or ask for, you know, transaction history and things of that nature. And then also to defend the VASPs side of it a little bit as well, you know, one, to something that we've talked about several times, is there is no clear guidance, you know, for these organizations. And two, there's been no enforcement from the IRS to these organizations, penalizing them for doing it the wrong way or telling them to take a different path.
Right. I mean, that's kind of the perspective I see, is that, you know, because it's not enforced or it's not mandated, let's say, you know, that some choose to not have that extra cost of reporting, to be honest. You know, they just said, I don't, you know, I'm not required to do it. But there has been some pushback on that, you know, mentality, because I think the users want that information. You know, they want to see, you know, at least compare it to their own records, even, you know, what is, you know, being shown as my, you know, my total transactions. I mean, that, you know, one of the more interesting things to me, kind of looking forward, and you know, presumably there is going to be some kind of mandate or at some point in time, you know, requirements for reporting. You know, what type of you know, cost basis reporting is also going to come with it, you know, and going to be required, and is it going to be you know, what cost basis methodology? Is it going to be FIFO as a default, or are they going to allow for other methods that are currently in play? So that to me is very interesting.
Awesome. And we do have 5 minutes left at this point, I'm being told. So if anyone in the audience is saving their question for the end, you know, now is the time to share, and we'll make sure that we answer it before moving on. While people are thinking, I'll use the airtime. You know, you mentioned regs and guidance. Is there regulations that, you know, with your, you know, ear to the ground, that you think is going to come? Is it going to be mandated for, you know, tax year 2021 at this point? You know, what are you expecting to change from a regulatory standpoint in going into next tax season, or are we already looking at 2022? And I'm not going to save you on this one too. I want an answer. Yeah.
Yeah, I mean, I haven't really heard too much. I would say that what we've heard, I mean, the FAQs, I'll just run the questions kind of at the same time. So there's something about the FAQs and whether you should follow the FAQs. By all means, do so to the extent that you can make sense of them. And what I mean by that mostly is, they kind of bungled them a little bit. They misdefined a few things on the airdrops and hard forks, and they sort of attributed one as they are one of the same thing, and it made it very confusing, and it really gave a sense that the IRS doesn't understand something that's been around for 5 years, and so what winds up happening is that there's essentially bad information in there, right? And then you look at what the IRS is doing so far, like more recently, which was they did do some clarification on trying to confirm that they understood what hard forks and airdrops were a year later. And then they put a questionnaire on the tax return, the 1040, saying, have you transacted with cryptocurrency? Check the box, yes or no. And it seems like a fairly simple question. If you've bought it or sold it or transacted with it, you should check the box, yes. And then the IRS agent comes out and says something along the lines of, if you've purchased cryptocurrency with US dollars, that is not transacting in cryptocurrency. And so now you have people saying, well, if I just bought it last year, do I check the box yes or do I check the box no? And the answer is, I don't know. I don't know what to do. I think you should still check it yes, because in those types of interviews and those types of those public speaking events, it's not something that you can rely on, right? As a precedent. And so the challenge we're having is the questions that we're asking on just the taxpayer level, when you talk about investment funds and partnership taxation and whether certain safe harbors apply or don't apply, how far away is the IRS from addressing those? Good luck, light years, right? And so I think that's what we're anticipating is no guidance here for this year on an investment fund perspective, which just leads us down a road of DeFi for 2 years or 3 years or 4 years,
Yep.
and us coming up with different answers. And the last thing I would kind of say to it is that what the challenge really becomes is that there's different service providers providing different advice and coming up with different conclusions. And so it's great, like Wendy said, that we are talking and we have groups like this, the Wall Street Blockchain Alliance, which please join if you'd like to, but so that we can talk to each other about it, because given to our own devices, we'll come up with the best decisions that we think are correct to our clients. And those might be very different depending on who you speak to. And it's a weird place for us to be.
Yeah, it's a very unique gray area. And, one thing that, Ryan mentioned that I want to circle back to is, the cost of compliance. And that was highlighted in Coinbase's S1. The fact that, they attempt to do things, by the book, and, competitively, it can potentially hurt them. So, you're left saying, well, as a VASP operator, it's certainly a balance. And tax in general, but particularly crypto tax is a layer cake, or maybe Dante's Inferno if you're working your way in. But the same way that there are layer 2 protocols, there's layer 2 tax problems. You start to think about, in addition to just reporting, then withholding, and we were even moving into unclaimed property, in a lot of cases, which typically means that assets have been dormant for 2.5, 3 years at this point. I mean, that's the mindset people have to get into. It's not a band-aid. It's a foundation that you're building on. And of course, again, you want to make sure that you're building on the right foundation. So, with that being said, I don't see any other questions coming in, Ron. I'm not sure if you see anything that I don't, but let me thank all the panelists first and foremost. I really appreciate the candid conversation. I hope I didn't put you on the spot too badly, and I thought these were pretty, not layups, but you can't get in too much trouble. So, Ron, with that being said, anything else before we want to hand off and transition to the next session?
I think there are a couple of questions that I think are worth answering. Dr. Sean, who's always good for a provocative question or two, dropped in a question around what is the strangest DeFi tax situation you have seen or heard of so far. I encourage any brave panelist to answer that if they get an opportunity.
Not coming also, from me. That's from Sean.
And also whether or not it's an institutional question, which is really the retail versus institutional conversation we hear quite a bit.
So from a DeFi perspective, I think one of the more interesting things that I haven't really looked into yet is the fact that Uniswap V3 is the liquidity pool tokens for Uniswap V3 are non-fungible tokens. And so due to the fact that you can have dynamic price curves on those, one liquidity pool provider is not always going to be equal to another liquidity pool provider. And so there's going to be, right when you think you crack the nut on how to like track transactions in a liquidity pool and how to allocate those transactions to liquidity pool providers, here comes this other wrinkle, right, which says, hey, this is a non-fungible token. And you're only going to participate in the liquidity pool during within this bandwidth of price action. And so there's something there where it's going to cause some, I think, other tax issues, specifically about whether or not the non-fungible token is like its own asset, unfortunately.
Not the strangest one, but one it's kind of amusing from a certain light, is that we see transactions from people who are experimenting with DeFi, not realizing the Ethereum network fees. And we're the only provider in the world that adjusts cost basis for fees for on-chain transactions, which is important for DeFi, very important. But people who are experimenting will do a trade and we're adjusting the cost basis and the fees exceed the value of the proceeds. So you shouldn't have even traded it at all, because like, I'm going to sell this for $100. The network fee to do this is $150.
Right.
And so we run into issues when we integrate the upstream professional accounting system. So we do a little tricky math to like put the fees on the acquisition side, because none of the systems will accept a negative proceed, right? So we see that quite often because they want to play with it. They want to experiment with low value, but they don't realize the fees in the current DeFi ecosystem, and they'll sell something and they'll pay more in the fee than what they get in the proceeds. And it's kind of amusing, not to them, but you know, it's interesting.
Great, thank you all. Kyle, if I could, just one or two other questions. And I want to go down this NFT route just a little bit. I know Candace posted something and it's a conversation a lot of us have had. I would argue that for the accounting profession, by the filings for 2021 next year, we're going to see a bunch of conversations around NFTs and a whole bunch of artists and creatives saying, is this ordinary income? What is this? And why am I in trouble? Do you see that level of complexity, or do you think we're beginning to, was it too soon for that?
Hopefully they're paying their tax and they're not in trouble.
I mean, I think the complexity that they often raise is for them, it's taxed as ordinary income, correct? Versus the speculative person who flips the next Beeple and makes $100 million, Kyle, it might be a different tax bill, correct?
That would be the idea, right? I mean, I think that's what the question is there some that are collectibles, which is a different tax rate, versus maybe some that are ordinary income? And I think somebody asked me actually just here earlier today that they'd heard somebody from the IRS make some flippant offhand comment about NFTs being collectibles. And I'm like, dear God, because they're not all, and we do not want them going and making that assumption. And so it's like one crypto is all crypto in their mind. So, when I think back to something you asked earlier, Kyle, I was thinking to myself, right now, my trajectory with the IRS, my conversations with them are all about, we need guidance for crypto trading. Like, I can't even get them to think about staking rewards or lending, let alone DeFi, so to your point, James, will we see guidance on some of those issues, at the account that we need from that tax level? Probably not. I think from our perspective, I know the Office of Chief Counsel spoke at an event a few weeks ago and very poignantly said we would have 1099B guidance imminent. But what does that mean? Does that mean gross proceeds? Does that mean cost basis? Does that mean 2021? I don't know, so definitely a lot of unanswered questions. But I think that we might see guidance for 2021 for B reporting simply because of that statement, number one. Number two, it's been all over the news, of course, the tax gap and the crypto guidance that's needed. But I think the third is that, the IRS really is trying to get taxpayers to report their crypto income. That's what the issue is. And even if the gross proceeds amount on a B, when a taxpayer receives a 1099, they're more likely to report that income, right, than if they don't receive a 1099 at all. And so I think what we'll see this year is some guidance to get around one form. So.
And I think NFTs are not all created equal, I think, is the other thing, right? It's like, it's kind of it's a non-fungible token, right? It's something that's unlike the other tokens, but you can have NFTs that have an underlying physical asset. You can have NFTs that are going to be, music rights, and the use cases for it will be very interesting. I think with the artists alone, right, and a piece of art, I've read something where you're going to be able to build into the smart contract, right, that every time that piece of artwork is sold, that a percentage of it goes to the original art. The proceeds goes to the original artist.
You get your royalty. That's right.
So in that case, when someone else buys it as an asset that they're hoping to appreciate and value, a collectible, right? Now, what is it? Is it a royalty, right? Is it a royalty payment? Is it actually, hey, this is, I will always retain their ownership rights of it to some extent. My name is applied to it, and so it will always go into this wallet, 10%. That sounds like a royalty, yeah. But they're not all created equal, and they're all going to have these different nuances to it. It's such an interesting area to be in, and it's really just at the very nascent stages. So I hope, like you said, Wendy, that they don't stub their toe out the door. Don't do too much, but just acknowledging that it's nuanced would be nice, because it would give people some flexibility.
Acknowledging different tokens, right? That we have stable coins versus crypto, versus NFTs. So.
Right.
All right. Well, thank you all. We'll leave it there. If there are any additional questions, please email us. We'll certainly reach out to our panelists. Kyle, over to you. And again, on behalf of the WSBA and all of our attendees, wanted to thank all of the panelists as well.
Thank you, Ron.
Awesome.
Thanks for having us.
Thank you.
You all.
Thanks, everybody.
We'll take a brief 30-second break, queue up panel number 2, and stay tuned, everyone. Thank you. All right, welcome back, everyone. Thank you all for being here. I think we've got our panel available and our moderator, Casey Johnson, an old dear friend from our from CPA.com, our global partners. Casey, over to you.
Thank you so much, Ron, and happy to be here. This session, we are going to address the growing occurrence and impact of crypto assets being held on public company balance sheets. Topics will include aspects of valuation, how corporate treasury and reporting will be impacted, audit for public companies, but this is an open Q&A session, so please feel free, post those questions, and we'll make sure to leave time at the end to answer any audience inquiries that maybe we didn't get to. Before we kick it off, I'm just going to ask each of our panelists to introduce themselves. I'll go by ABC order for last name. Rod, you want to kick us off? Oh, you're on mute.
You're on mute.
Thank you, Casey. Sorry about that. My name is Rod Brennan. I teach advanced auditing and information technology in the MBA program at Rutgers. I'm also involved in research, and I'm an author on accounting, auditing issues related to blockchain and distributed ledgers. And I am an advisor to several companies, but particularly to Lukka, which is a company that does middle and back office accounting and reporting and auditing solutions and data products for the whole crypto space. And I'm just really glad to be here.
Excellent. Thank you, Rod. Joey, you want to introduce yourself and give a little background on your crypto experience?
Sure, thanks, Casey. Hey, everybody, I am Joey Ryan. I am a CPA, ex-public accountant auditor, worked at a couple big firms in the past, and I'm currently now the co-founder and CFO at Gilded. And we are a back office accounting and payment solution for businesses to be able to track crypto and utilize crypto for payments. And yeah, been in crypto since early 2017. So seen a lot of highs, seen a lot of lows. Today is no different. So yeah, happy to be here and help answer any questions.
Thank you. And a lot of you may know Jagruti, but she recently made a change in her job. Jagruti, you want to introduce yourself?
Sure. Hello, everyone. So I'm Jagruti Solanki. I'm a CFO at BitPay. I actually joined BitPay about 6 months back. Prior to joining BitPay, I was an audit partner at a CPA, top-tier CPA firm based in Atlanta, Aprio. I was with the company 12 years and been working with a lot of technology companies on the audit side, audit and financial reporting side for several years. Half of my career with my prior gig was working with technology companies, including blockchain. So really, BitPay was my first blockchain audit client, 7 years back. And just funny thing, when I got introduced to blockchain and BitPay back then, I was very skeptical about the whole space. And here I am now with a company doing a lot of cool stuff. So BitPay, we are the world's largest crypto payment processing company. Outside of payment processing, we also do payroll processing in crypto and have a prepaid debit card where you can top up crypto and use that at different checkout points. So happy to be here.
Congratulations. Good to see you. And Pat, want to introduce yourself?
Sure. Hi, my name is Pat White. I'm the CEO and co-founder of BitWave. BitWave is the market leading solution for businesses, for tax and accounting, for businesses that are using crypto. So we sort of specialize in this duality that is crypto, where any transaction is both an accountable transaction and a taxable transaction. We really help bridge the gap. So work with a lot of the top tier ICOs and companies, and now we are the main company that kind of does DeFi in the space. So I'm excited to talk about all this stuff. This should be a fun panel.
Excellent. Thank you guys so much for participating. And I'm Casey Johnson, Senior Director of Strategy and Innovation at CPA.com. We are the business and technology arm of the AICPA. And as Ron mentioned, we partner with the WSBA on pretty much everything blockchain. So let's level set. And Jagruti, I'm going to start with you. What is the current landscape for crypto on public company balance sheets, and who are the more famous firms that are holding it? What others might we expect over time?
Yeah, so great question. I guess my response would have been different, a week back, but I'm going to tweak that a little bit. So, last, I would say probably about 6 months or maybe longer, almost like 9 months back, we saw a lot of public companies looking to kind of change the way they do treasury management, or what I call load their balance sheet with Bitcoins. MicroStrategy, I feel like that was one of the companies that is in news a lot. They in fact took some loans to load up their balance sheet with Bitcoins at a pretty decent average cost, dollar cost average basis. Tesla followed that trend. There are a couple other companies that followed pretty much the same approach, but I feel like MicroStrategy was one of the leaders who almost was an example for a lot of Fortune 2000 companies looking into a different way of treasury management, or even long-term investments, so to speak, right? Like whatever the goals are. Now that said, as you guys, some of you guys might know, with Tesla and the recent kind of press around, the ESG concerns around holding Bitcoins and transacting in Bitcoins, and is that a concern, or what will change as a result of what's been happening with Tesla? I personally, it's going to be interesting to see what other companies end up doing. I feel like from an ESG standpoint, a lot of the public companies might be a little more under scrutiny, especially from their board and kind of investors, just from a reporting standpoint, and might need to justify and clarify a lot more now with the recent developments with Tesla. So I think it's going to be interesting to see how the recent developments kind of pan out in the near future.
Tesla's always making news, right? So Joey or Pat, maybe one of you can expand on what you guys have seen in terms of evolution of demand over the last, maybe 6 to 12 months.
Yeah, absolutely. There was, and actually, I'll say there was two, Grudy, there was two that you missed that I thought were so interesting that our public companies have got into it. One was Time Magazine, which is a 100-year-old company that decided to up and buy crypto, which is, hey, good for them. And then the other one was Topps, which is the guys that made the baseball cards, who have decided to, I think they did a reverse merger into a public company, and they're going heavy in on the NFT stuff. So it's crazy things. Market's just going nuts right now. I mean, I think from my perspective, when we talk to a lot of the public companies on the Treasury guidance side, you obviously have a tension from the audit committee on your board about cryptocurrency. So your audit committee is coming to you. If you are actually a public company CEO that is reasonably asking to add crypto to your treasury, your audit committee is going to ask you some very difficult questions about what the hell you are thinking about in your life. With all of that being said, there is really great ammunition for you as the CEO in that case. What we're seeing a lot more and more is people kind of laying on the inflation. So, theoretically, for a long time, crypto has been held up as a deflationary asset that's going to be a hedge against inflation on the US dollar. We just saw the inflation in the US in January hit 4.3%. So that's already this idea of everyone's a little bit nervous about inflation. So we're seeing more and more companies come to their board with saying, hey, we want to diversify into crypto for two reasons. One is to sort of as a straight hedge against inflation, get on the balance sheet. Let's take that. US is about to print $2 trillion more after just printing $2 trillion a couple of months ago for a new infrastructure package. Let's hedge against USD inflation. And the other one is we are just seeing tons of companies getting into Ethereum development. That's why I wanted to mention Topps, because in order to do any NFT development, you're having to bring on a lot of Ethereum and actually hold that Ethereum on your balance sheet and then use it for development purposes. And reasonably speaking, what's been so interesting is you look at a company like Microsoft, which probably at some point bought, let's say 1,000, 10,000 Ethereum for their various blockchain developers. They have a pretty big Ethereum development group. That holdings is now worth hundreds of thousands, if not millions of dollars. And it goes from essentially not balance sheet impacting to balance sheet impacting very, very quickly, which then of course makes all of the vendors on this very happy, because then you need software to manage it and all the other things that go there.
Yeah, I mean, not much more to add to that. I agree that, it's interesting to see where these public companies or private companies, I mean, every private company right now is having discussions at an upper management level about their crypto and blockchain strategy going forward, kind of utilizing it as a technological play per se, as to how they can get a competitive advantage in their industry over other competition. So, despite the price, I still think that's, those conversations are happening today and into the future, especially as more and more businesses are going to be onboarding and utilizing crypto, not just for treasury purposes, but for payments and actually transacting in crypto. So it'll be interesting to see, in the next 3 months, 6 months down the road, how all of this unfolds.
It's interesting, last week we saw a letter from members of Congress to the FASB chair, and that they are now pushing for balance sheet classing and clarification for crypto assets. Rod, how specifically is crypto reported on the balance sheet today? And can you expand on the challenges as well as these recent developments?
Sure. To say this, that of course the FASB and the ISB have been all but silent on any classing of crypto at all. The only precedent accounting that I'm aware of is the Japanese accounting standards boards, which did say that crypto should be, fair valued if it's actively traded in orderly transactions in active markets. Let me illustrate it with this little example. So, and this is actually aligns with one of the companies mentioned earlier, but so I buy crypto. I'm a US company reporting under US GAAP. And unfortunately, we as a practice have decided that crypto should be classed as a long-lived intangible. And that's like a patent or a license. And because of that classification under US GAAP, you're only allowed to impair downward. And there's no upward impairment because, a license or a patent generally is designed to degrade over time. Under IFRS, you can value crypto on a balance sheet. And by the way, this is crypto, I need to say, that's held on your own behalf. If it's a qualified financial institution, then you can use fair value. But Tesla and MicroStrategies and others, they're holding it on their own behalf. And so we went through the whole litany of, well, it's not a cash or cash equivalent. It's not an inventory. It's not a financial instrument. So we landed on this abysmal valuation or a class of a long-lived intangible with this problem with GAAP. So I'm an investor looking at making a transaction, and I'm looking at a US company that bought crypto Bitcoin at $15,000. It went down a little bit at my impairment point, so I impaired it down to $14,000. And then it proceeded to go up to $60,000, or I'll say 49 where it is today, or 39 where it is today. And then I'm comparing a similar company that I want to make a transaction on, reporting under IFRS. And in that case, they did value it at fair value because they're allowed to as a long-lived intangible with the same classification. And now I have an incredibly different, look at those companies for doing a transaction. And unless I look at the non-GAAP reporting for the US GAAP company, I could make a really poor decision. And I think this monolithic approach and the approach that Casey, you just mentioned that the 7 congressmen encouraged was that we take a use case based approach, because all crypto is not the same. To argue that crypto sitting on a balance sheet for Tesla, MicroStrategies, or someone else is a long-lived intangible, such as a patent or a license used in the production process versus an investment instrument is crazy. And there's a guidance from the FASB, which is called Concept Statement Number 8, and it's what they use to do convergence discussions with the ISB and other gaps. And what it says is that you should make sure that the decision you make about classing or about anything is relevant and a faithful representation of the economic phenomena. So relevance refers to the ability to make a decision. And with the example I just said, I'd make a very poor decision if I classed under US GAAP and used a cost basis for Bitcoin on my balance sheet. And faithful representation is that it really represents the economic phenomena that's going on. And Tesla could sell their Bitcoin tomorrow, so could MicroStrategies. They can't sell their patent or their license or whatever. So I think there's the letter of the May 12th letter from the congressman was really clear that there's lots of other classes that could be used. And one example that they didn't even mention, in addition to the ones they mentioned as financial instruments or inventories, would be commodities, because the CFTC already has intangible assets that are managed under the CFTC as commodities, such as interest futures and others. So I think we made a big mistake trying to class this stuff as a long-lived intangible, and I think that needs to change. And I think it could change even without specific guidance from the regulators, because we could argue that that as these congressmen did on May 12th, that there's other classes that could be used, and we need to use a use-based class. So that's a long answer, but I just wanted to give you an example of why this is just such a bad classification.
Well, it's worth mentioning also that even though this panel is a little bit more focused on public companies, at the end of the day, there are a lot of companies that are not public, that are not doing the GAAP treatment that the Big Four have kind of put forward for crypto. So we work with a lot of businesses that are choosing not to do an impairment model on this, intangible impairment model, and are doing other types of mark-to-market treatment, or commodities type treatment, or even inventory type treatment. So because there's so few companies right now that are the public companies working on this, that a lot of people in the audience might actually be from private companies, and you actually have a lot more leeway to opt into other treatments that are truer. I think it was a great phrase, is truer to the economic, ideals or the economic purposes of the instrument.
Right, right.
And to add to that, there could be companies that maintain 2 sets of books, right? Or maybe 3. There's a so-called GAAP basis, and then there's a fair value adjusted, and then there's a tax basis book. So it just kind of adds to complexity of 3 different sets of books just to track crypto assets.
Yeah, I mean, that's what we're seeing to degree is businesses are coming to us that are basically treating it, similarly to cash. They're, if they're private companies that don't have GAAP reporting requirements, they're saying, I'm going to track this just like cash, and I'll track it for my tax reporting purposes at year end. But right now, they're because if they're transacting and using it basically as cash, going back to that use case scenario you were just talking about, Rod, in their mind and the way that they view it from kind of management perspective, if they're kind of reconciling their financials and doing kind of management reporting at month end, they're viewing it as cash, right? If they have a gain or a loss, that's great. And maybe they do have a piece of it that they are viewing as like an investment purposes where they are trying to maximize some gains. But, internally, they are having like separate sets of books where they're tracking, as like a cash asset and just recording the.
Yeah, I'd like to see like you said, Pat, the small companies and Joey are using other classes. And I think we should feel the freedom to do that in the absence of guidance, because, one of the problems I think in the whole crypto blockchain space is that, we don't really take a hard enough look at how we can align with existing standards, because, the old saying, be careful what you ask for, because you might get it. In terms of regulation, we can align very well. And when we get to valuation, we can talk about that. We can align with fair value valuation methods with crypto in a very disciplined way. And even though we don't have any specific guidance on it, just by association.
So I'll throw this out to the group, and then we can come back to fair value stuff. But what about the interplay with tax liabilities and reporting?
You have to keep, if you are going to get into cryptocurrency as a business, you have to be proactive about using a solution that will both help you on the accounting side and on the tax side. It is very difficult to do this by hand. Outside of buying 1 or 2 assets and holding them and then selling them, if you are doing any amount of real actual activity, any amount of large scale trading, any of that, like you need to be very proactive about tracking your taxes. Everything in crypto is a taxable event. It's absolutely insane to sort of when you really dive into it. But even, like a very common scenario that you'll see that might not occur to everyone. It is incredibly common for people to be doing token to token trades anymore. So, you buy Bitcoin, and then you decide you want a little bit of Ethereum. So you sell the Bitcoin directly into Ethereum. In those situations, you are often seeing the exchange themselves take the fee in cryptocurrency. So depending on how you're doing your treatment for the fees, whether you're capitalizing or not, you may be picking up a transaction in cryptocurrency, even if you had no intention of actually doing that. Like even if you were only going to do this for investment purposes and only to hedge your treasury, you might be picking up actual transactions. And that when you are disposing of those fees, or even just moving between wallets, when you're disposing of those crypto fees, like those are taxable events. So crypto is this very unique world where literally everything you are doing is a taxable event in a way that like a lot of the systems we deal with every day are not used to. We're just not used to having moving money between accounts suddenly be a taxable gain loss event as well as an accounting event.
Right.
Yeah, I'll add, one of the things, again, this goes back to the reporting complexity, right? Tracking that cost basis, which is different for tax and different for the so-called GAAP, and likely different for IFRS, depending on which approach, companies are using. And yeah, I think that's where it really gets challenging on, where I said, you almost have to maintain a separate tax basis kind of set of records. Yeah, it's clearly not. And then you put all the other, the DeFi things that happen today in the space, or you have forks, airdrops, swaps. All of that just kind of complicates not just the tax side, but also how you account for those on your books.
So let's go back to the valuation. So will crypto on the balance sheet affect pricing and valuation of public companies given the volatility potential, especially that we've seen in the last few weeks, and how do you value? Pat, I don't know if you want to start, or Rod, either of you.
That's a tough question. I'll let Rod take that.
I was gonna say, who wants to take the the bullets?
Well, let me just touch on the valuation for a second. We at Lukka, along with the Continuous Auditing and Reporting Laboratory at Rutgers, developed a pricing or valuation methodology for crypto under ASC 820 and IFRS 13, which basically says there's, of course, 3 levels. Level 1 is actively traded assets, and it says to identify the principal market and then take the exit price off the value of cryptocurrency, or a benchmark if it's financial reporting or appropriate. And so what we did was we came up with a very careful dynamic model to follow, and this is what my point earlier, that we can follow ASC 820 and we can value cryptocurrencies at fair value in a very effective way. And now we know from the Bitwise report to the SEC and other studies that have been done that 85, 95, whatever number it is, % of the exchanges have some kind of wash trading or some type of manipulation going on. So what we did was we came up with a qualification score first of the some 200 or 300 exchanges that are out there. And the only thing that makes it more difficult than securities is instead of having 15 or 20 principal markets potentially around the world, you've got thousands, but what we do is look at compliance issues such as KYC and AML, looking at order and efficiency around spreads, looking at other factors, decay, when was the last, how soon has the volume in there, and then come up with a score on that, and then volume and decay adjust that value. And we have a very good ASC 820 aligned level 1 valuation system for cryptocurrencies. And I think it's arguably good. It's not the same way a security is done, because the New York Stock Exchange is the principal market. And now we're working on, the paper was published in the JAF Journal of Auditing, Accounting, and Finance. And now we come up with another model for level 2 assets where you don't have observable transactions. And we're using a critical path approach. And that's, of course, a mark to model approach. So there you're allowed under GAAP and IFRS to use a model approach. So we came up with a model way to do it. And level 3 might turn out to be a pricing desk, a manual pricing desk. But so we can align with standards. And I think I could argue with someone from the FASB, and the SEC came out and they said you should be using alignment with standards for pricing thinly traded and actively traded assets. So we need to be doing that independent as well. So I think there isn't a huge problem. It's much more complicated. You're not going to do it on a piece of paper, because it's got to be an automated system in order to get an accurate valuation under fair value. So
yeah, I'll take a stab at this one also, since we also have a pricing engine that is slightly different than the way Lukka approaches this problem, because at the end of the day, you are making an opinion about these assets. And it is very interesting, because this idea of thinly traded versus fat markets or long tail markets is a very tricky one, as now we are moving into the DeFi space. And so at this point, we are at a very reasonable place where there is more transaction volume going through decentralized markets than there are going through centralized markets, a few of the centralized markets right now. And so any pricing model that you are doing that is not taking into account the actual decentralized markets, the peer-to-peer markets, is inherently going to be missing very valuable pricing data. So there is a point at which the IRS is giving guidance that you want to be using as an individual or as a business. You want to be doing pricing off of the exchange where you're trading the most. And that tends to be very easy guidance to follow, because the exchange will have the pricing data for what you want to do, because that's where you're trading. But that, of course, doesn't deal with this problem of having to have a very robust set of fallbacks to go from, hey, we can't price the asset off of the exchange that we're on, so we need to move to all the exchanges. It's not being traded on all the exchanges, but wow, it's being traded at billions of dollars a day on DeFi. So we have to move to actually grabbing DeFi snapshots. And Uniswap is a great example. Uniswap actually publishes out a moving price average that you can grab for them. Balancer now does too. So you actually can go to the next level and grab price averages from smart contracts on the Ethereum blockchain and BSC now also to do pricing. So the way that we tend to approach this is that we look at this in terms of you kind of move from the best granularity you can to where you have to be, because at the end of the day, you have to price your assets. Like you can't get away with not actually pricing assets. You have to have a price for it. And so we work very hard to be able to provide a price.
Yeah, I think we got to be careful though, because a lot of what in the IRS FAQ 26 says you can use, indexed pricing or VWAP pricing, to price for tax purposes. But the guidance that the SEC encouraged, aligned with the FASB and the ISB, would be to use, principal market exit price. And I agree with you, Pat. We need to have the DeFi data in there too, because that's a growing part of that. But having said that, I think just taking an average is not aligning with the standards and isn't going to help taking an index, an average across a bunch of exchanges, isn't going to help the standard setters come out with guidance, because it violates their own guidance that they have now for fair value. That's kind of a point.
Yep. I was like the enemy of, or good enough is the enemy of perfect. Wait, no, flip that. I mean, at the end of the day, like these things have to get done. And there's, there is no exit pricing off of DeFi liquidity pools that I'm aware of. I mean, I have to go and I have to get my technical accountant hat on for that one, but like, it just is starting to kind of change. The places where there's billions of dollars of value being transferred is starting to move off of traditional exchanges, and that creates issues.
And then to add to that, when it comes to fork, for example, Bitcoin Cash, right? I think from a valuation standpoint, also important to have a policy around when you consider, that you have control over the forked item, if you got it so-called, right? Like when does a company consider that they have constructive receipt of that asset that they are technically in control of? And some of the valuation consideration will depend on that, policy, so to speak. So it's kind of gray. It can get gray and subjective, and obviously add a lot of complexity from that standpoint. Like it's almost like a level 1 asset, but then you almost have level 3 kind of metrics built into that level 1 to come up with a value, so to speak.
Right. I was gonna say, we just touched on 3 topics that are so gray area, where you're talking about valuation for tax purposes, valuations for GAAP purposes on the balance sheet, if you're a public company, disclosing your fair value requirements around the inputs, and then dominion and control over actually when you receive these assets. So God forbid you have a forked asset that has some level 3 inputs for evaluation on your GAAP reported 10K at the end of the year. I mean, that's a rabbit hole times 20. Right now, in terms of being able to make sure you're reporting the proper disclosures and following all those guidelines that the SEC and US GAAP has out there. So this is definitely like very detailed stuff that we all, even us as quote unquote industry experts, sit here and debate all day, because again, without kind of the proper frameworks and structures in place, we're all operating, as they said on the prior panel, we're all operating in some sort of a gray area, trying our best guess at following the current guidelines in place. So I just found that kind of interesting as I was taking a step back, kind of listening to these.
Yeah, and Joey, to your point, talking about public companies and even private companies, so to speak, just speaking back on Bitcoin Cash, like when the fork happened back in August of 17, I believe that's when it was, we would probably consider that as a level 3 asset, right? Based on some valuation that, we would estimate based on level 3 metrics. And then as the liquidity, I guess, increased over time, and, it's kind of moving up the chain to level 1, you now have additional disclosures to move that level 3 to level 1. And it's interesting. Again, a lot kind of depends on how companies are looking at it, and kind of goes back to the policy. What position are you taking, and is it a defensible position?
Yeah, we got some great questions that might be interesting. Like one that Dr. Sean sent out was, do we think that the noise around all this will keep private firms from going public? I think this, and then there's like a corollary question to this, which is, will public companies have reticence to acquire blockchain companies also. That's one that's like I've spent a lot of time thinking about this idea of like, as businesses are starting up in this space, if you do a more exotic funding instrument like an ICO or an STO or whatever it is you're doing, there is a very real risk that a business looking to acquire you will literally just not be able to do it because of their auditors, their lawyers, whatever it is when they're actually evaluating it. So you think of like a company trying to look at Ripple right now, and with like, you know, SEC lawsuits and all the different things that are hanging over their head, and trying to actually say, hey, we'd like to just buy your assets. It would be very, very difficult for that to happen right now. And I got to think, and I've never taken a company public, so I don't know the answer, but I've got to think that that's similar to actually going public. It's all the same concerns. Like if you have any sort of weird instruments on your balance sheet, people are going to ask you some really hard questions.
Yeah, a lot more scrutiny for sure.
Yeah, and Ron, maybe I'd like to pause here before we get into the discussion around globalization impacts. Are there other questions that you've gotten that you want to throw out there for the group?
Yeah, let's thank you, Casey. Let's address a couple of the questions that were put in the Q&A. Sean, obviously always good for a provocative question. What would you say to ease fears about recent volatility to treasurers or CFOs? I think there's no shortage of treasurers or CFOs who'd say, I'm not involved and they're happy. But I think, is there anything that you'd add to that, where you see that progression going and how treasurers and CFOs can be relatively comfortable in this kind of complex space?
Wouldn't it be funny if we were having this conversation just a couple of days ago before this drop? I'm checking my phone here to see where my Bitcoin's at this point. So no, but I think, you know, keep in mind that as we saw crypto tank, so was the stock market. And the real strength here in this whole thing is really not any particular coin, including Bitcoin, but it's the blockchain. And I think that, you know, the confidence that CEOs and others and treasurers should have in this market is that the blockchain is here to stay. And there's some bigger things on the horizon, such as tokenization and other things that are being, you know, introduced through non-fungible assets and stuff. So I think it's, you know, I think we're going to see a continued, you know, delving into this by both small and larger institutional companies, a little less controversial than Elon Musk, you know, so, but we'll see. Yeah. Thoughts?
I would say to a CFO that, like, for a lot of large enterprises, they are going to end up with digital assets in the next few years, whether they really want to or not. Yeah. So what we see on our side is we're seeing businesses that are starting to look at, you know, legitimately issuing crypto bonds on the blockchain and doing debt issuances on the blockchain. We're looking at people moving to whitelisted KYC lending pools for satisfying, you know, corporate debt and borrowing money and paper and things like that. So, you know, it's one of those funny things where, like, if I were having a discussion with a CFO, what I would say is, you know, dear CFO, you know, you are going to get dragged into this no matter what. It would sure be nice if you just bought a little bit of Ethereum right now to understand what it takes to hold on your balance sheet, to understand what you're looking at, to figure out your accounting practices now, so that when your CEO comes to you with a crazy idea in a year and a half, you're not scrambling at that point to figure it out. And that's to Rod's point exactly. I mean, there's this inevitability of, like, DeFi is this inevitability of digital assets, traditional financial instruments moving to the blockchain, and it is happening in an incredible clip right now.
Yeah, Pat, just to put you hit the nail on the head there. Same with you, Rod. You know, we're seeing the same thing, right? The demand is there; it's coming from the ground up. You know, businesses are going to be, like you say, forced to be, or it's inevitable that they're going to be forced to, whether it's transact or hold it on their balance sheet. You're going to see this, you're starting to see this kind of crypto payroll thing starting to play out, where employees want a portion of their salary paid to them in crypto. You're going to see businesses, you know, we're all global now. So businesses that do business globally, where they have vendors in different countries, they're employing software developers in different countries. They're going to be requesting payment in crypto, faster, cheaper, more transparent. They can avoid the wire fees and all the transaction fees associated with it. Even if it's, you know, sending stable coins, right? Because businesses, you know, aren't necessarily in the business of taking on kind of volatility risk. So even if they want to dip their toe in the water with stable coins, or CBDCs are coming. We all know that. So when you have kind of a stable asset that a business can transact in, and you're moving from kind of that traditional financial system or the traditional payment rails to the blockchain payment rails, we're all moving and shifting towards this digital space. So it's inevitable that's going to happen, and it's a matter of kind of getting these CFOs and treasurers, ahead of the game and be able to prepare for this as that wave is starting to come.
Yeah, as an audit professional and a researcher and professor of auditing and for MBA students, the thing that gets me about this that I think is inevitable is that I know there's exceptions to this and people argue it, but at the end of the day, the whole blockchain is cheaper, better, faster, and it's way more secure than what we do today. I mean, we don't believe that because the pipeline got hacked and they paid in Bitcoin, but that really has nothing to do with the security of a blockchain. So but the security of this is incredible. And that's going to help it, keep going here. It'll have setbacks like today, but.
Well, I think about it like especially when it comes to traditional financial instruments, I think about it in terms of like, you look at what Goldman is using to run some of their bond markets or something like that. I mean, we're talking, AS400s and COBOL and the machines that are older than I am at this point running those markets. There's no way you can't have, by moving to a more mature product that is basically the way it's been designed from the ground up for this stuff. Like there's just gonna be so much recapture of like fees, so that friction is just going to slide off of it, and like all that's going to go right back into the pockets of all the people wanting to do things like issue debt or borrow money or whatever. So they're like CFOs got to get on this. I
mean, we got to figure out how to audit it and how to have compliance on it. That has to happen fast, and that's in the works, I think. But otherwise, there won't be mainstream or at least institutional adoption because they wouldn't be allowed to.
Yeah.
Well, a couple of things I would add to CFOs, as a recommendation would be, start small. I mean, I think and to me, frankly speaking, the starting step would be open a wallet, create a wallet, learn how to manage your keys, right? Get comfortable holding keys, and, start with really one small asset. And I guess, as you get used to that, the second phase would be, now you can plan on, building your balance sheet with kind of balancing out your cash equivalents and what you call digital assets, and somehow kind of figuring out a strategy where you are using the dollar cost average methodology and not just holding on to all assets but disposing of or selling, I guess, from a liquidity standpoint. So you're not putting all your eggs in one basket, and you don't get into a situation like today when Bitcoin at $30,000 and everyone is like panic right there. I mean, it's like you want to avoid that kind of panic from at least a treasury management standpoint. So come up with a strategy where you're almost evening out your risk, so to speak.
It's about building muscles, right? Like we always forget, like there's all these muscles that you build as a CFO or as a finance organization within an enterprise that all have to get rebuilt for crypto. All of them, like every one of them, from even something is like what you do with your bank accounts and how you have multiple signers on bank accounts. Even that is different in the crypto world. And so like you want to start building up your muscles now so that when you do have to worry about this later, it's not all new stuff at that point.
Okay. Ron, I think you had another question from the audience.
Yeah, a couple of questions coming in, and one of them from Candice: does dominion and control mean that public companies can only hold crypto on crypto exchanges? And this answers a really interesting question that we often have at the WSBA, particularly from members in public companies when they think about things like hosted versus unhosted wallets. I would ask for the entirety of the panel: do you foresee a public company implementation over time where they can have that combination of hosted or unhosted wallets? Or they always need to have an account at Coinbase, for example? And what does that future look like?
You already see public companies with unhosted wallets. I mean, any public company doing any Ethereum development right now live has unhosted wallets within their organization. Now, there's sort of a separate issue there, which is that in a lot of these cases, what a large business will do is like they'll have a manager or some sort of person high up, and when they move funds into developer wallets, they'll just write it off at that point. So they call it an expense at that point, and then they don't worry about it. But that's not actually the correct treatment, especially now that could be worth a lot of money. So like you already are seeing unhosted wallets for some businesses. That would be my contribution.
I think a lot will also depend on the company's security controls over their entire infrastructure. Again, goes back to key management, right? How good is the risks around the custody aspects that they defined? Do they have a SOC 2 or something, or some sort of equivalent on the custodian aspect where they're holding their assets? And if they can prove that the risks with us holding our assets in a self-hosted wallet is better than holding it at an exchange, then why not? I mean, as long as they can convince their auditors and get a green light from a risk standpoint, I mean, I don't see an issue with that.
Great, thank you. And one more question, and Jagriti, if we could stay with you, I think it'd be great to at least start there. One of the other conversation points we have as we see firms, both public and private, preparing for that future, I think, Pat, that you mentioned, where people get paid in crypto. Jagriti, you're seeing payment processing and kind of preparing for payments in different, what used to be called, or what are called altcoins broadly. The complaint we get from colleagues in the space is, I can't even forecast against any of these. What am I going to do in a future when half the employees want to get paid in Doge, for example, which might be a scary proposition? What is that conversation, what does that conversation look like, Jagriti, and obviously for the rest of the panel as well?
Yeah, no, great question. By the way, we are getting questions on can we get paid in Doge. So
we're getting questions to support Doge.
It's not uncommon anymore. In fact, we actually at BitPay, we started supporting Doge, I believe 2 months back or 3 months back maybe. And it's I'll be honest, like Doge is becoming a decent chunk of our settlements. So yeah, people are looking to get their payments settled using Doge. And one of the reasons is because the fee on Doge is not as high as Bitcoin or Ether. So from a payment standpoint, there's a good use case there on why Doge, right? And from a payroll standpoint, we at BitPay have been paying our employees, our contractors in crypto for almost 10 years, almost since we started the company. And then we are offering that same solution to other companies. We are seeing an increasing amount of public companies, by the way, not just private companies, where public companies are also looking to offer that to their employees. Now they start small, which is perfect, right? I mean, you want to start really small, get comfortable, and then get whoever is on the other side, on the recipient side, you want them to be comfortable with the risk they are taking, right? And they kind of need to understand that this is not true cash, so to speak, it's crypto that's coming in. I think once it's past that point, I do see a lot of potential for growth in just that aspect. So yeah, I almost feel like today, like a year back, the discussions we are having with companies is, what is crypto? Why crypto? I mean, that was kind of the discussions. And now it is, how do I use crypto to process certain payment or to pay an international, vendor, or to do some cross-border intercompany transfers? Those are the kind of questions we are getting, which just shows me that market is a lot more evolved. We are past that early stages of, skepticism around the whole crypto space. And we are getting into the second phase. That's what I think, second phase of using crypto, whether it's spending it, at a store or merchandise buying or e-commerce or, payroll, whatever the case might be. We are definitely seeing a lot more developments and sophistication around that side.
So I'll throw this out. Sorry, Ron, did you have another attendee question?
No, can I add something though, real quick?
Go for it.
I'll correct you, Ron, because it was Joey that mentioned payroll. But we both are like, mid 30s white dudes with beards, so I get it. It's all right. Good.
Yeah, no worries. Easy to
we're
us.
Essentially the same. But I was going to add to Jagriti, there's actually another thing that's coming down the pike that's super interesting. Around payroll and which I don't know if we actually want to spend time debating it, but there is something that's fun to debate, which is we're seeing a lot of people starting to do streaming payroll, which is this idea of where you set up a smart contract, and the smart contract is between you and your employee. And what you as a business do is you deposit a certain amount of money into it, and over the course of the pay period, your employee basically gets one block worth of that pay period's crypto released to them every single block. So they don't have to actually take it, but they have the ability to take their money on a block by block basis over the course of the entire 2-week pay period, which has super interesting implications on the tax and accounting side, because it is not at all clear how you account for that. If you treat that as a draw on like a second by second basis, if you just treat it as paid at the beginning of the period, or there's all these sort of interesting questions around it. But payroll is gonna be a place where the intersection, like once you have these smart contracts, you can actually go to the next level, is that people can then borrow against their smart contracts on DeFi markets and things like that. So there's going to be, again, getting this idea that like once these things start hitting, they're going to sneak up on CFOs in a really nefarious way. This is another one that like when you actually had the opportunity to get paid on the blockchain at a second by second basis and borrow against it without having to have, Western Union or whoever does, I don't know, the payday loan in the middle of it. Total game changer for employee satisfaction and employee engagement. So that's all.
I want to point out that I now have 30 head explode emojis on my desktop, Pat. So thanks for all of that. and that nothing here is a recommendation of Doge in any way. Casey, there is one last question there was another question from the Q&A, if I could, from Kedevan. How nonprofits disclose their assets? How can nonprofits disclose their assets when they receive crypto donations, or should they convert to USDs and recognize gain or loss? Any brave souls?
Well, I'll take a shot at it. Joey, go ahead. You're going to say something.
No, I was expecting Rod to give us a FASB disclosure answer.
Let's go to the professor.
Go ahead.
Yeah. No, go ahead, Jagrudi.
Well, I mean, and you're receiving a donation, it's an income. I mean, the time you received, the donation. The question is, did you receive it in USD? If you did, then, easy accounting is just, USD received as income. If you did not receive in USD, if it's crypto, then, question goes back to the whole valuation piece, which, Rod, you are an expert on. So, you can.
Yeah, no, it wouldn't be any different than any other property that you receive, and how whether you convert it to US dollars or you keep it as property, and then it has a basis that you got it at, and then it appreciates in there, or depreciates. Yeah.
There is one interesting question there. I don't think we want to get into it, which is there's like kind. So from the other side of it, there's like kind donation rules and things like that get really complicated, which also start getting into if you're doing like kind deposits into funds or LPs or things like that, that is also a very complicated place. So that was like one of the interesting issues that we saw around nonprofits I actually honestly can't remember what it was about, but it was around this idea of like, you as the donator of Bitcoin, what can you do? Can you do special treatment there? Like, do you have to be doing it at fair market value and then recognize a gain loss? Like what exactly you do from the donator side of it? I think that's more complicated.
For those good with payments, let me just ask a question to the rest of the panel. What about this de minimis, threshold? Are we going to really see retail crypto if every time I buy a cup of coffee with 1/1,000th of a Bitcoin, I have a capital gain or loss to report on my taxes? Do you think that's going to be critical to real payment adoption and real commerce?
It's certainly how we do it. I mean, for what it's worth, like we track tax laws on a transaction by transaction basis, and we have mechanisms to roll it up. But I certainly have taken, or we as BitWave have certainly taken the stance that on a per transaction basis, you're creating a taxable event that you need to be dealing with. And like, I'm sure we'll get to the point, like if Starbucks really starts taking this, we will actually get to the point where they're rolling up on like an hourly basis or something that's a little bit less than 1 million transactions, 1 million transactions. But I'm firmly of the belief that we will continue to see this as a taxable on the individual basis for the foreseeable future.
So last question kind of for the whole group, and I'd like each of you to go through.
Casey, can I ask Rod a question back?
Sure.
Rod, Professor, let me ask you a question though. So where I think it gets more complicated. So I think as long as I'm paying for a coffee with Bitcoin, I think for the foreseeable future will be like that. When will it change for stable coins? Like, will it ever change for stable coins where if I pay with USDC for a coffee, can they just start treating that as USD income? Will that ever change, or will it not be until we actually see like a central bank digital currency?
Yeah, I wrote a paper that's in the Lukka library on this concept of, what is a stable coin worth, and argued, and other people argue as well, that it should be that a stable coin should also be valued not at its reserve currency, but be valued at its market price, at
Right.
fair value. So that's kind of, now you can argue that if a stable coin really is pegged and reserved 1-to-1 and it's audited, that it's worth $1, and it is when you acquire it or when you burn it. But to value it, I think you have to use fair value and a principal market exit price. So,
because the value of the coin bakes in things like transaction fees and all these other things,
and even geographics and time zones and other things that impact the value of an asset, of any asset, even a stable coin.
So because I'm hoping for a world where we can stop doing some of this tax treatment for stable coins in the not distant future, but it sounds like maybe that's not going to happen.
Now, I think we need a de minimis threshold, or we need some kind of guidance, like there are with other things that every time you buy a cup of coffee, it doesn't become a taxable event. I think that's a real drag on commerce with crypto.
Sorry, Casey.
Good question.
No, I'd like to end with kind of each of you giving your predictions. Or maybe it's predicting a big company that will come out next, or will we see just in general more activity, less activity? So Rod, you want to start with your predictions first?
I've been, for the reasons Jacardi just mentioned earlier, I tell my students, get in with $100 into crypto and start to use it in order to understand it, not to make money. And I followed my own advice 4 years ago or so and bought some cryptocurrency, and a total investment of probably only about $15,000 in increments of 1,000 or 2,000 on different coins. Some I lost my shirt on. My wife encouraged me recently, let's get the money back that we had in it. So I sold my Litecoin investment, got my whole $15,000 back, and now I have a significant amount of money, not a lot, but enough, just play money. So, but most importantly, through that, I've learned, it's helped me to understand the implications and the future of this, disruptive or economic phenomena. And I feel like it is here to stay. This is a setback the last couple of days. We're all in the doldrums over this, but again, because it's cheaper, better, faster, potentially, and way more secure, and it removes that friction, and it's international. The people that are saying it's like the horseless carriage are going to wind up on the wrong side of history, in my view. There'll be setbacks. There's a lot of things that have to happen. The regulators need to, and they will get involved. And I think they've been wise about it, like with the internet, where they've said, let's wait and see how this pans out. And that's what the FASB is doing. That's what PCAOB and and other regulators and standard setters are doing. And that's not a bad thing. So I think we're going to see more balance sheet activity from institutions and private companies. The one challenge I see too is though this whole auditing area, because if you think about it, you're transacting on Bitcoin, and you might have a SOC for your exchange, you might have a SOC for banks that you work with and other key people, but who's auditing the blockchain itself for IT general controls? So for example, if I said to you, would you go out and audit the Bitcoin blockchain? That's a little bit like saying, hey, Joey, would you go out and audit the internet for me? No one owns it. No one's going to pay you to do it. And if you did do it, it's a massive job. So I think we need to figure out, and I think there's some really cool research going on and automated ways to do that. So I think we're here to stay. Elon Musk isn't the last person that's going to invest in even in a big way, I think, in cryptocurrencies. Whether it's Bitcoin or not, I don't know. But I think the future is bright.
And I'll say, Rod, Ron gave me very similar advice when I met him 4 or 5 years ago, and my husband is very upset why I didn't do about 3 or 4 times the amount that I went in with. Maybe not today, but last week.
$100 bucks. So, put $100 in.
Jacker, do you want to give any of your predictions?
Yeah, I mean, I wish I could predict Bitcoin price, or one of you guys can, and I can decide what I need to do. I think, just given what's happening in the space with a lot of these larger enterprises now getting comfortable with crypto, OCC almost kind of letting banks, consider stable coins for settlements. I feel like banks, will, I don't know how long it might take, maybe a year, 2 years, 3 years, but the reception of banks kind of receiving the whole stable coin concept for settlements and processing, I think that's going to really move the industry much faster, at least from a regulation standpoint, and just clarity from accounting guidance, etc. I think that is going to be a pretty decent move. The other thing, what I think is consolidations. I mean, today, just in past 6 months, we have seen a lot of companies doing almost the same things, or kind of a small little piece of a bigger picture. I think down the line, we might see a lot of companies kind of finding ways to work together, a lot of partnerships, strategic partnerships, consolidations likely, maybe more M&A activity in the next couple of years. I mean, that it wouldn't surprise me with, those kind of trends happening the next few years. I mean, again, very much similar to Rod. I think blockchain, digital assets, they are here to stay for sure. We'll just see a lot more sophistication as the year progresses.
Pat?
I love this. This is so much fun. I started the year out on a podcast with Dr. Sean, predicting Bitcoin hitting $100,000, and that prediction is just going swimmingly at this point. So, so I'm super excited about any further predictions here. But I think there's a couple of things here that I will speak to. I mean, it is absolutely, we'll see more businesses getting bringing it onto their balance sheet. Like, there's absolutely no doubt in my mind that we will continue to see a steady drumbeat of businesses large and small, either intentionally coming out and saying that they're buying it for their balance sheet, or announcing that they happen to have, I honestly, I just keep imagining Microsoft, where they probably have, tens of millions of dollars of crypto on their balance sheet right now. And they don't really know what to do, because it kind of snuck up on them. Like, they had a little bit, Microsoft has a little bit on their balance sheet. I've heard from their security research team, because they'll pay Bitcoin to buy dark web exploits. They have a little bit for their Ethereum developers. Like, you go through one of these phases like we're going through right now, and suddenly you suddenly have millions of dollars almost accidentally. So I think there are a lot more businesses that will start to heat. That's almost inevitable. Where I will focus my predictive powers is on is DeFi. I mean, we are going to see a just enormous amount of businesses starting to use DeFi over the next year. So in the next 6 months, there will be I don't even know if this is a prediction, or this is a just like known thing, but you're going to see a bunch of DeFi markets coming out that are going to be KYC AML'd, where it's the first time that public companies that are essentially regulated and care about compliance will be able to start getting into DeFi. That will be happening over the next 3 to 6 months. As that happens, that will change how people think about financial empowerment. Like, that will change the role of finance within businesses. So finance, as the group that manages the relationship with the banker, changes drastically to being a group that can actually make real decisions on borrowing money, with one click of a button on the blockchain. And all of that. So that's kind of my take on this, is that the next 6 months, we'll see enormous uptake of DeFi by enterprises. And I stand by my Bitcoin 100K. I stand by it, whether I should or shouldn't. I stand by it.
Well, this is being recorded, so Ron, we're gonna pull these out at the end of the year. Joey, last one for the predictions. What do you think?
Yeah, it was great points by everybody. Everybody said has thoughts about basically what I agree with, which is, the technology is far superior than anything out there in the traditional financial sense, as Rod said, and what I like to preach: faster, cheaper, more transparent, and the most secure network in the world, right? If you're talking about the Bitcoin blockchain right now. So it's just inevitable that businesses will adopt this. What's different now between, if you want to say the crash now between 2017, we were so early. The applications and the infrastructure in the space was still very early being built out. I mean, BitPay was there, but not many other businesses were actually around kind of building infrastructure in this crypto space to allow individuals and businesses to transact and easily start onboarding into this space, right? So I think in the last 3 years since then, or 3 to 4 years, we've been building that infrastructure. A lot of businesses, all of us that have been in this space, Lukka, et cetera. I mean, Lukka's been around for a while too. We've all been building the infrastructure to allow businesses and individuals to easily onboard into the space, easily transact, easily understand how to use crypto, and easily start taking advantage of the blockchain payment rails. And I think that's why today the crash kind of won't be as far down as I think what maybe some of the doomsday people are saying, is because that infrastructure layer, that base layer, is there. And we're only building more and more in the space as every day goes by. So, and as Rod and Pat and Jagrudi have said, you're seeing the institutional players that are in the game now, and these businesses are going to be forced to adopt it because they're going to see the demand coming from not just their employees, but also the vendors and outside individuals as well. So the demand creates, basically the businesses being forced to onboard into it. And I think you're just going to see it, kind of take off from there. In terms of price predictions, I was saying ETH 5K by summer. We almost hit it. So I've been saying that for a few months. I'm still pretty bullish on ETH. One thing we actually didn't even talk about on here at all really was NFTs. I think DeFi and NFTs, I've been listening to a few Mark Cuban's podcasts that he's been talking about DeFi. He's been crazy into DeFi over the last 6 months. He sees DeFi as a untapped multi-billion-dollar market. Same with NFTs. We know that he's busy either investing in or buying NFT marketplaces. So I think both of those places are kind of primed for explosion, and that's just going to help kind of the adoption and growth of Ethereum going forward. So right now, not financial advice, but my chips are on ETH going forward.
Well, we will dive into both NFTs and DeFi at next month's blockchain symposium. So stay tuned on that. And I think as our host, Ron should give his prediction. I know everybody would love to hear that.
Oh,
and I would love to thank
That's
all
the one
of you
I
as
want
well
to hear.
this panel.
So it will be, this is not financial advice by any stretch. My board makes me say that. Bitcoin 250 by the end of 2022. And in the next 60 days, Casey Johnson will launch.
Wait, 250K or $250?
250K.
All right, guys.
And in the next 60 days, Casey Johnson will launch Casey Coin, which will be the absolute de facto payment rail for all global transactions all around the world. And next meeting will be on her yacht.
Yeah.
Love it.
Thanks, Casey.
Figure out an NFT before we figure out that. But to the panelists, thank you guys so much. This was fun, and appreciate all of your insights. Thank you to the attendees for your questions and keeping the conversation going. Ron, we will turn this back over to you.
Absolutely. Thank you, Casey. Thank you to all of our panelists. Thank you to all of the attendees. A lot of these deep conversations will be happening as part of the WSBA practice workshops and all of the work we're doing with our friends and colleagues at all of these firms and AICPA and CPA.com. So recording will be available shortly. Thank you, everyone. Have a great rest of the day. It was a lot of fun.
Thanks, everybody.
Thanks.
Bye-bye.